Emil Walter joins us right now. We'll just speak to him. Emil, thanks for joining us. He's head of regional strategy, Asian equities at RBS Asia Securities. Emil, in the last few days, global markets and including Asian markets seem to be either lost direction or perhaps heading downwards. What do you make out of it? Is this a short move, or do you think the markets had run up very fast, so they're just trying to adjust to economic reality?
I think very much the latter of what you pointed out there. There seems to be two principal views of the world at the moment. One which is portrayed by the bond market, obviously the largest, most liquid financial forum in the world. The bond market is telling us there's broad-based liquidation of debt taking place in the world. This is a deflationary process, and as a consequence, growth is slowing down very dramatically. On the other hand, equities have been living the dream, looking for 4% global GDP growth next year, looking for 16% regional EPS growth, none of which will come to transpire. I believe it's going to be time to catch up with reality in the next weeks and maybe months.
Right, Emil, morning, this is Avan joining in from the studio. With respect to the kind of jitteriness that we're seeing overseas, and India really seems to be piggybacking on that kind of sentiment, do you think that India can completely decouple itself from the overseas and global scenario altogether?
Almost certainly not. I've just been in India actually last week, and one of the interesting things to take away from me compared to when I was there earlier in the year is the fact that the local mutual funds and also the local life insurance companies are not the same stabilizing and indeed supportive factor that they were previously. What this means is that the influence of foreign money flows is extremely high when it comes to Indian equity prices, and should there be a reversal because of a dramatic slowdown in global economic activity and a consequent rise in risk aversion, I'm afraid there could be some negative impact on the impact of Indian share prices.
Emil, I want to bring up two issues, especially because you brought up the bond market. What I've been seeing is that the commercial paper market for 3-month paper, even the best rated companies, which is P1 Plus, who used to pay about 6.5% about 3 months ago, are now actually raising 3-month commercial paper at 8.4, even 8.6. So A, liquidity seems to be tight, and secondly, most companies in India don't seem to be going up in stock price because of operational issues, but because either they're doing a QIP or an institutional placement or announcing an expansion. What do you make out of it? I mean, to me, sometimes it looks like a flashback of '97 Asia, where all the talk was just expansion. Nobody really talked numbers anymore.
Yeah, I'm afraid I can only agree with you. I think what's certainly positive compared to 2007 is that the overall levels of valuations in the stock market are clearly not as high as they were back then. Equally, I think the level of speculation, i.e. the amount of just purely punting capital that is involved at the moment, is less so. Having said that, your point about the monetary policy cycle is very evident, and I think a net a negative for Indian companies and the government. And equally, the fact that there is a great deal of speculation, and actually money flows is deemed by most investors to be the most important factor for the stock market, has got to make you worried. You know, if you look at the earnings results in the last quarter in India, very few companies blew out the lights. By and large, these are numbers that are reporting in line to perhaps even below, and yet the market has been resilient. I suspect the next few weeks will be a challenging period for the market.
Mm-hmm. How much of an adjustment do you think, Emil, is possible? And the reason I'm asking this, you also see institutional investors, and in a very low volume market, which is what we have. For example, we have volumes of only 50,000 in Hero Honda or 50,000 in HDFC Bank. Any significant selling, even from a single institution, could, I mean, obviously there's no buyer out here. So how serious are they about reducing their positions? Perhaps that could decide everything that's happening locally.
Yeah, actually I think there is a buyer for Indian equities and Indian assets in general, but probably not at the current prices. Our estimate is that Indian equities are a little more than 1 standard deviation expensive here compared to the long-term valuation history. which suggests that we probably have to witness a decline of more than 25% just to get to fair value. Having said that, if the whole region falls 25%, actually we would be about 1 standard deviation cheap. So the relative premium that India is enjoying and has been enjoying for a long period of time remains very much in play. If that premium was to be taken out of the equation, in other words, India would be given less of preferential treatment than it has been in the past, perhaps because of less conducive global liquidity conditions, then obviously the decline would have to be commensurately larger. The bottom line is, I think there's little risk of the market running away to the upside, and that should, be reflected in your viewers' choice when it comes to investments, and particularly when it comes to stock selection.
Right, Nemal, just one question before we let you go. In terms of the domestic data that India has been throwing up, it's been quite encouraging in terms of the results. We also had monsoons auguring well for India. Do you think that we're sort of discounting these domestic factors altogether?
I don't think so. I mean, I think that the market is looking for the good news, which is why it's creeping higher on low volume. But actually, you sort of weigh the good news versus the bad news, and I think at least in a cyclical context, in a shorter term context, speaking over the next sort of 2 to 4 quarters, I'm afraid there is more bad news to be priced in than there is good news. It's true, monsoon seems to be coming in better, yet the inflation numbers are not really moderating to any great extent. The current account deficit continues to widen. This is an issue, and as a consequence, the rupee has significantly underperformed other Asian currencies. There are pressure points here to bear in mind, and I think although the long-term prospects for India remains, reasonably encouraging, and obviously the potential is great, we have to deal with some of the cyclical and shorter-term pressure points very soon.
Okay. Emil, in this scenario, if you had to decide between holding certain sectoral bets, letting go of certain sectoral bets, and buying into certain sectoral bets, how would you break it up? I mean, would it be banking? Would it be infrastructure? Just based on as you see things at the moment.
Well, my colleague Parul Sani, who's our Indian strategist, have recently released a new report where he basically advises investors to take profits in the financial sector. So we are advising our clients to go underweight the financial sector because it appears actually the fundamental momentum here is not very positive. The outlook for earnings is not especially encouraging, in particular in the context of monetary policy. And furthermore, this is a very consensus holding. Almost by default, people have a lot of these shares. The one sector that we do like above any other is the telecom sector, where we think people are overly pessimistic. Clearly, the fundamentals have not been great, but we don't see any further deterioration, and the valuations are quite attractive.